All right, welcome back. Let's take a look at futures and a busy week of earnings this morning. The Dow Industrial's near the lows of the morning, down 166 right now. The Nasdaq's down 135. We are looking at the earnings that's really driving this market here. Tesla stock, one to watch. After reporting its profit yesterday, stock is down 6.75%. The company's price cuts contributed to a 24% decline in first quarter profits at Tesla. The stock is still up 46% year to date, but it's having a rough time this morning. Joining me right now is the Fitz-Gerald Group Principal, Keith Fitz-Gerald. Keith, good to see you. Thanks so much for being here. What does the earnings picture tell you? Compare that to the valuations. We still have a market that is up year to date in the double digits if you look at the Nasdaq.
Well, it's not too bad, is it? You know, for all the negative headlines, the numbers with regard to stocks themselves and specific stocks are actually pretty darn good. I think it's a chance to refocus on the stocks that really matter. To use an expression that Mark, I know, is fond of, you keep it on the fairway. This is big quality names. This is time to be very selective. Tesla's a great example of that. You know, everybody's poo-hooing what's happening with regard to margins, but we've seen this before with regard to batteries, the charging network. I think he's playing from a position of strength. Many companies are, in fact.
Maybe, but Mark Tepper, jump in here, because as you've noted in the past, this rally in the Nasdaq is very narrow. It's about 5 or 6 stocks.
Yeah, so Keith, I want to get your take on the breadth of this market, because only about 60% of the S&P is actually trading above the 200-day moving average, and that's down from over 70% about a month or two ago. So it's trending in the wrong direction. S&P's up 8% this year, but if we look at the equal-weighted S&P, that's only up 3%. 90% of the S&P's returns have come from 10 companies. So what do you make of that? Is this a healthy rally? Is it unhealthy? What do you make of the breadth issues that we're seeing in the market?
Excellent question. The way I look at this is it's a lot like old-fashioned cable television. You've got to pay for the stocks. You don't want to get the stocks you do if you're a fund investor. What this tells me is that it's time to be very, very selective. There's a lot of capital still looking to chase very few comparatively good stocks. That's why you're seeing the narrowing. So to me, it's a time of great focus. It's a time of great patience. But importantly, we also know as individual investors that when everybody knows something, investors tend to do absolutely the wrong thing at the right time. So to me, this is a buying opportunity for very cautious, very focused investors.
Well, what does this mean for the Fed, and what does that mean for the macro story? I mean, look, Chicago Federal Reserve President Austin Goolsbee spoke yesterday on the outlook for the economy. He said we're still waiting to see whether there are other credit shoes to drop. How much squeezing is going to be coming up from the bank side? It's going to matter for whether this economy is going to slow down, Keith. So what about that? We've been talking, Mark and me, about commercial real estate now for a while, and we're waiting for that to see if that's going to be another shoe to drop. Next Fed meeting at May 3rd, we've got most people expecting another rate hike. But where does that take the broader story?
Well, I got to be honest. I wish they'd take the microphone away from everybody at the Fed except for the chairman, because I think it confuses markets and a disservice to individual investors. You know, commercial real estate to me is a serious problem because all these vacancies are never going to return to pre-COVID levels. They've got problems getting people back in the office. So there's a huge dialogue. I think a lot of REIT investors are going to be shocked. But with regard to the broader macro picture, I think we've already been in a recession. So again, I think we're closer to the end of it than we are to the beginning of it. So I look at the calculus a little differently here, Maria.
Bob Nardelli, jump in here. What are you seeing in terms of the macro story?
Yeah, Keith, I would ask you the following questions. I mean, I've talked a little bit about, I see a tremendous amount of debt coming due. We saw Bed Bath & Beyond this morning, who have been struggling for some time, talking about going into bankruptcy. We see Rite Aid struggling a little bit. I mean, I think there is yet another shoe that's going to drop in the second half. Your opinion on that, please?
I would share that opinion. I think that the distinction, though, is that it's very important to remember you can be an economic bear, but still a market bull with regard to specific stocks. If you're playing to a long-term strategic vision, and you know this better than I do, that you want to act to that vision. I think the right companies are doing that. Apple's a great example. It's moving forward 3, 4, 5 moves ahead of the stock market. As investors, if you do your homework, I think you've got a great setup there for the visionary CEOs, not necessarily the broader macro story itself.
All right, we'll leave it there. Keith, always a pleasure. Good to see you, sir.
Thank you, Maria.
Keith Fitz-Gerald joining us.
Hi, it's Keith here. Thanks for checking out today's highlight clip.
What'd you think? Did I make sense? Is there something you'd like to add? Make sure you leave a comment down below, and of course, click subscribe to keep up right here on YouTube, or sign up for the email newsletter at the link below. You can also find me on Twitter and Instagram for my real-time thoughts on markets, analysis, and a whole lot more.